After a cooling off period from a sizzling hot IPO market a few years ago, Chinese companies are now coming back to the US to go public. More than a dozen Chinese companies have filed so far. And microblogging giant Weibo began trading in the US today, but things have not gone quite as planned. Karina Huber joins us live in the studio for more on this. Karina, good to have you with us tonight. A bumpy start, but a good recovery today.
Yeah, not bad. I mean, we're talking about the pricing. Weibo didn't come in as high as it expected. But when it comes to trading, initially we saw that the shares were trading below the IPO price of $17 a share. But by the close, they were trading at $20.24. So that's a rise of about 19%. Now, while a 19% jump is good, it is a world away from the pop that we saw over at Twitter, which came out in November. So that's less than 6 months ago. That pop was 73%. So why am I bringing this up? Well, that's because Weibo is often called the Twitter of China. And so the question right now is whether its relative underwhelming performance was due more to something specific to Weibo, or whether this tells us something about the greater market.
Executives at Weibo celebrate the company's first day of trading on the Nasdaq in New York. But the listing got off to a rocky start. Investors bought fewer shares and at a lower price than Weibo had hoped. The company raised $286 million in the offering. That's a little more than half of what the company was targeting. Analysts like Echo Her at Maxim Group says investors are worried about growing competition from text and messaging app WeChat.
WeChat right now is #1, so it's distracting a lot of users from Weibo.
Weibo's number of monthly active users continues to grow. In March, it had 143 million, but WeChat now dominates with more than 355 million. Another potential risk for Weibo investors, the strict internet regulations by the Chinese government.
But the timing of Weibo's U.S. listing is less than ideal, and that likely had an impact as well. While the IPO market was red hot at the beginning of the year, over the past few weeks, the majority of U.S. listings have priced on the lower end of their range, and a large chunk of them are trading below their IPO price.
That wasn't the case with Weibo. Its shares closed 19% higher than its IPO price. Analysts believe in the long run, Weibo could be a good buy.
If people want to tap into social media growth in China, Weibo is a very good outlet there.
You want to look at it as a diversification play in a portfolio which includes Facebook, Twitter, and probably Tencent and others.
While the pricing of Weibo's IPO may have been a disappointment for some, the pop in the secondary market is a good sign for Chinese tech IPOs.
Now, what Schuster and other IPO experts are saying is that companies wishing to go public will need to be a little bit more realistic about the pricing in their listings, perhaps a little lower than what they'd hoped for a few months ago to get their deals done. Michelle?
All right, Karina, with this IPO, Alibaba actually raised its stake in Weibo to 30%. So the Alibaba ownership, did that help or hinder?
Well, Michelle, it really depends on who you ask, because some investors were saying, look, if I want to get exposure to Weibo, I'm just going to wait for the Alibaba IPO, which is expected sometime later this year. On the other hand, there are some that are speculating that perhaps Weibo will be bought out entirely by Alibaba. So for those people who believe that might happen, now could be a nice time to get in at this price.
All right, we'll see what develops. Thanks for joining us, Karina Huber.